Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 30 days in 3 minutes. October really was a great month, with the S&P climbing 8.1%, the Dow 14%, and small caps 11%. This was the Dow's best month since 1976 and its best October ever. Every single U.S. sector was in positive territory, with energy leading the way, much like it has all year. In fact, energy is the only sector with a positive year-to-date return at 66.4%, so keep an eye on that. Bonds of every stripe are now yielding between 4.5% to 9%. One-year CDs are yielding just over 4%, and money markets are in the low 3% range. When was the last time you remember yields like this? To be sure, we're not out of the woods, as everyone remains focused on the Fed's next move. Much of this year's market volatility is attributed to uncertain Federal Reserve policy, especially with respect to the terminal rate, which represents the forecasted rate at which hikes will stop. It constantly changes in response to new information. We started the year at near zero Fed rate and then quickly climbed to nearly 4% after the recent 75 BIP increase. The markets just want to know how much higher the Fed plans to go. As the market's terminal rate forecast moves up and down, stocks and bonds immediately price this in, and it's a messy process. The October rally was primarily driven by this concept of a Fed pivot, which gained steam as officials started to debate when and how to stop raising rates, which the market interpreted as fewer and smaller rate hikes with a lower terminal rate. Then, November's hike came in exactly as expected at 75 bips, and the markets carried on until Jerome Powell emphasized, "We are firmly committed to lowering inflation, and we have resolve." He further elaborated how demand far outnumbers supply. The U.S. job openings remains plentiful, and the labor market remains extremely constrained. He said it's very premature to consider pausing rate hikes. If we don't get inflation down, it will become entrenched. The ultimate level of rates will be higher than previously expected. Well, this meant Wall Street's terminal rate just went higher. So markets quickly reversed, further supporting how strongly valuations and the terminal rate are intertwined this year. The positive spin here is that recent economic data is already hinting at inflation easing, so investors still believe future rate hikes may be smaller. We're also seeing some softening GDP figures, with earnings and earning estimates coming down, so the Fed's measures are having at least some effect in reducing demand in the global economy. Rents are falling month over month in many markets. Commodities are at 7-month lows. Retail inventories are elevated, forcing retailers to cut prices. Container freight rates are dropping sharply, and manufacturing prices are down 36% from a year ago. All of these factors point to reduced inflationary pressure in the months ahead, which could be good for stocks. Throughout history, stocks fall as inflation approaches a peak. They rebound strongly once inflation starts to come down, and we think we're getting close to this point. As we've said before, volatility is the price of admission for long-term investment gains, which rewards the patient investor. Again, thank you for your trust and confidence.